OMG peeps, and today I'm bringing you guys a video, or a tutorial rather, to explain and show you something that is a very powerful method to find high probability setups. So there is what we call internal range liquidity and external range liquidity, in short IRL, and ERL, right? These two abbreviations, these two concepts are the only two things that you need to consider when you're analyzing for your setups, right? So let me show you what I mean by internal range liquidity and external range liquidity. This swing high right here, this swing low, this swing low, this swing high, fair value gaps and order blocks, we refer to those as internal range liquidity, and swing highs and swing lows, we refer to those as external range liquidity. Okay, so the main concept behind those two terms is that it's a cycle, right? From internal range liquidity to external range liquidity, back to internal range liquidity, out to external range liquidity. So when you understand that, you realize anything that price, any move that price does is either to purge external range liquidity or to mitigate internal range liquidity, right? So if we look at this chart right here, if we look at what we have, let's start from this high because these are the four most recent highs that are inside, right? So this was external range liquidity. Price came down, mitigating some internal range liquidity at this point, and then it shot up. When it shot up, it took out this buy side liquidity, which is external range liquidity, and after shooting up, it started crashing. Why was it crashing? If it's crashing, then it means it's coming to take out external range liquidity or some internal range liquidity. And in this case, when it started crashing down, when it reached this point, it started reversing, going up. Why is it reversing, going up? Why is it not taking this store side liquidity? Why is it going up? This is telling me we just mitigated some internal range liquidity at this point, right? So if we mitigated some internal range liquidity at this point, we mitigated internal range liquidity, what's the next step? External range liquidity, right? That's the next target, because we have mitigated internal range liquidity. So we are heading for what? We're moving from internal range liquidity to external range liquidity. Which one is the external range liquidity? Between the fair value gap and the swing high, the buy side liquidity. I'd say this is the external range liquidity. So we're coming from internal range liquidity going to external range liquidity. That is on the 4-hour time frame, right? If that's what we're looking at, let's see what kind of internal range liquidity resides at this area. We can see price was crashing. Then at this point, it found support and it created a swing low going higher, right? So once it started going higher, which one was our first valid swing high break of market structure? Between this one and this one, which swing high was the first break of market structure, or break of structure in short? Was it this one or was it this one? I say it's this one. And if it's this one, if I'm correct, then my analysis should look something like this. We have a break of structure right here. I need you all to see. We have a break of structure right here, and before this break of structure, we had this order block, right? And we can see clearly. Hold on, let me do this. We have this order block before this break of market structure. We have this order block, and we can see clearly price was crashing. As it was crashing, we mitigated this order block somewhere around this level. Let me just mark it so you can see what I'm saying. Alright, so we mitigated price at this level, and when we mitigated price at this level, price didn't stop crashing. It kept crashing. Why didn't it reverse and go up? Why did it go down? Since we mitigated the order block already, I'll show you why. Because price was mitigating something inside this order block that we cannot see on the 4-hour. So we're going to have to go down to the 1 hour to see exactly why price reversed at this level. But first things first, I'd like to see where the consequent encroachment is, just to know exactly where to look for signs of internal range liquidity, or to look for proof of internal range liquidity being mitigated, right? When we go down to the 1 hour, the midpoint of the order block is the consequent encroachment, in case you're wondering. So let's go down to the 1 hour. When we go down to the 1 hour, price already mitigated this. The last order block is this one, right? We already mitigated that. We actually went through the midpoint of the 4-hour order block and reversed from that level, which is below this level. So we move our consequent encroachment measure tape, if I might say, to that level, to this order block. Let's measure this order block. And this order block, the consequent encroachment is right here on the midpoint, which is where price reversed from, right? Can you see that? In case it's not too clear, and I know it's not clear for you guys, let me go down to the 15 minute, just so I show you what's saying. So down on the 15 minute, you can see the midpoint is this order block right here, which is where price reversed from. But actually, we can see on the 15 minute we still went under that level, right? So I'm just going to put a horizontal ray here to see exactly. So let me just change the color so you can see, you cannot be confused, right? Let me put yellow. So that is the lowest point price went to, right? If we go to that, we'll see what's there, an order block, right? So price reversed from this order block. That's the internal range liquidity on the 15 minute that was being mitigated. 15 minute order block that was being mitigated, and then price started trickling upwards. Let's go down to the 5 minute. On the 5 minute right here, we can see price had a break of market structure right there. And when we had that break of market structure, we have a fair value gap right here. On the 5 minute, we have a fair value gap right here. Can you see it? So that is the internal range liquidity that was being mitigated on the 5 minute in the order block right there, just below that level. That's the internal range liquidity that was being mitigated on the 5 minute. Can you see? Price came in first, it dipped, went up, came back down, took out the external range liquidity, and it went up. Once we have confirmed that we actually came in for some internal range liquidity, we know for a fact that we're going for external range liquidity up here. And in case you're lost, let's go back to the 4 hour. So right there, internal range liquidity going up for external range liquidity. Let me just remove that because it's not of use at this moment. So we're looking for buy setups, right? We're looking for buy setups. So let's go to the 4 hour. And on the 4 hour, we can see we had the first break of market structure down here. Fair value gap, it got filled. Break of market structure right here. Break of structure right there. Fair value gap got filled right there. Break of market structure came back down and mitigated this order block right there. Break of market structure right here. Can you see that? If this fucking 4-hour candle closes above this break of market structure, above this break of structure right here, if this current 4-hour candle creates this break of market structure, then automatically we know and we can see we have this fair value gap. And what do we know about fair value gap? Since we're going higher, our first entry position would be right here. That is our first entry position. Our first entry position would be on this fair value gap and the stop loss just below this low. Internal range liquidity, external range liquidity, don't forget that. This is our first entry, right? It's a 8% setup. It's an 8% setup. 8% setup. 1 to 8. And this is most likely going to take a couple of days, because you can see on the daily time frame our entry would be right there. And since we're going higher right there, if you look at the weeks, actually this might take one week, 2 weeks type shit. 1 week, 2 weeks, I don't know, somewhere there. 1 week, 2 weeks. Anyway, let's go down. We are on the 1 hour, and on the 1 hour we can see clearly clear as day. We had this break of market structure, then we mitigated this order block right here, this one right there. We mitigated that. Then we had this break of market structure right here, this break of market structure right here. We actually mitigated everything down here after this break of market structure, right? Can you tell we have mitigated everything down here? Look at this candle, this next candle, this candle, this one, this candle, this bullish candle broke the structure right here, this high, broke this high, it closed above, right? So it created a break of market structure, and after creating a break of market structure, the next candle, this one, went all the way down to this low before reaching this low actually, and it mitigated everything that was in here. All the internal liquidity that was in here has been mitigated by this candle, so it's not likely that price is going to come back to these levels, and if it does, I don't think it will go down below this order block, but I don't think it will come back down because of this candle. So once we know that, we realize, we know we still have the 4-hour fair value gap. So within this fair value gap, there is there must be a 1 hour PDRA that is likely to hold price. And when I look at it, I see we have this break of market structure, and within the 4-hour fair value gap, we have this PDRA, which is a breaker block, the 1 hour breaker block, right? So this is where most likely I think price is going to come before heading high. So what I see is price is going to come down here to this 1 hour breaker block, go up, do that, and head to that level. But let me not leave it there, let me go even lower. So on each time frame, I'm going to have a setup. So since I think on the 1 hour, this is my entry, I'm going to put my entry just above that level, and my stop loss just below there, and my TP at that level. So this is the trade setup that I have on the 1 hour, which is a 1 to 14. Decent, if you ask me, very decent. Current interval only. Let's go down to the 15-minute. So on the 15-minute, all I have to do is look for a PDRA around these levels, this 1 hour order block, this 1 hour breaker block, excuse me. I won't lie to you, on the 1 hour, the only thing I see clearly is break of market structure, and we have this order block, 15M order block. This is all I see price coming to mitigate before committing to the buy side momentum. So I put my entry right about there, my stop loss on this low, and then my TP same as that, which is a 1 to 9, and it's actually on the 15-minute. Our setup 1 to 9 is lower than the setup we have on the 1 hour. On the 1 hour we have a 1 to 14. On the 4 hour we have a 1 to 8, right? So even though my main TP is here on this double top, my first TP will be here. This is TP1, TP2 right there, TP1, TP2, and then the final TP, I'll just leave it up there. Internal range liquidity and external range liquidity. I hope you have learned something, and if you have, make sure to leave a like, make sure to subscribe, and stay blessed. Stay killing the profits, stay getting the profits, stay killing the markets. It's your boy OMG Peeps signing out.
And remember, forex we're talking about, we came in this game for money. We came in this game to earn a living. So we are not here to play games.